If you're hiring someone, you've got two choices: W-2 employee or 1099 contractor. Choose wrong and it can cost you a ton in unpaid taxes, penalties, and interest, and years of hanging out buddy-buddy with the IRS. And in this video, I'll walk you through the difference so that you can make the right call for your business. And I'm Jasmine DiLucci. I'm a practicing tax attorney, CPA, and enrolled agent. I got my first tax license in high school. And in today's video, we're going to go through the legal and tax difference between an employee and a contractor, what can most likely create IRS problems if you choose the wrong one, the exposure if you get it wrong, and finally, my recommendation on how to protect your business. So first, what is the difference between a W-2 employee and a 1099 contractor? Okay, the legal distinction comes down to one word: control. A worker is required to be a W-2 employee when the business has the right to control the details and means by which the results are accomplished by that person. Okay, simple in theory, but it is messy in practice. It's a facts and circumstances test, which means it is a big gray area, and the IRS loves to push people into employee status because it generates more tax. Sometimes double tax if the worker has already paid as a contractor and the IRS still makes the employer pay tax again, plus penalties and interest. Now that's the federal test. States, a different story, right? Most follow a similar premise, but some, like California, are stricter and treat almost everyone as an employee. Now that's the legal distinction. The tax distinction for the business paying the worker is primarily who is responsible for the employer side payroll taxes, which is 7.65% of the total pay. If a W-2 employee, then you as the business owner pays, and if a 1099 contractor, then the worker pays since they are self-employed. So now that we know the legal and tax difference, second, we want to cover what realistically creates an IRS problem in this area. Okay, the IRS doesn't really do random payroll audits. When you're getting audited for payroll, they already know what they're looking for. Okay, so here's the two common triggers in context of this topic. First, a 1099 worker who files for unemployment. Most states, no matter political affiliation, tend to be pretty favorable towards awarding unemployment. Then the state sees that you never paid into unemployment insurance, audits you, and then reports the results of the audit to the IRS, finding that the worker was an employee, right? Or second, a 1099 worker files a form with the IRS saying they should have been a W-2 employee. It can open up a review, and if they're right, then you have a problem. Now, let's discuss what happens if you get it wrong, because you might be thinking, honestly, what's the big deal? I'll just pay the difference I would have owed. Case closed, right? No. Or honestly, this decision wouldn't be important enough for me to do a video on it. So if a worker you paid by a 1099 is converted to W-2 and you lose the case, this is what happens. You pay the employer payroll taxes that you should have paid, about 7.65% of the employees paid. You then pay the employee payroll taxes you should have withheld from the employee's pay but didn't, another 7.65%. And the big whammy, you pay the employee's federal income taxes that you should have withheld. That is right. You hated paying your own income taxes. Just wait until you pay someone else's, and then you pay very high penalties and daily compounding interest on top of all of that. And let's say this tax bill puts you out of business. You're like, I'll just shut down my doors and the IRS won't be able to do anything because I created 8 Wyoming LLCs and 3 Delaware holding companies based on advice from social media. You'd still be out of luck because the majority of the tax bill comes with personal liability, no matter how many legal entities you structured on top of each other, because the IRS is not just any creditor. So what can you do? Here are my recommendations. Okay, first, default to W-2 when the control test points that way. If the worker looks and feels like a part of your business, they're probably an employee. This is especially true when someone performs services within your line of work. For example, if you run a law firm and you hire a paralegal, that is almost certainly an employee relationship. But if you hire a maid to clean your office, that's outside of your line of business, and often it is presumed that you don't control the details of how that person does their job, since you don't even know the details of how they do their job. Second, if someone insists on being a contractor, when you see IRS exposure, I would add safeguards. Okay, require a legal entity. If they want contractor treatment, it is reasonable to ask them to operate through an LLC or corporation. The IRS is far less likely to reclassify payments made to a business entity as employee wages. And also use an indemnification clause, okay? Add contractual language that says if the IRS reclassifies them, you can recoup your costs. It won't guarantee protection, but it discourages the contractor from reporting themselves as an employee later, since that could put them on the hook. Consider materiality. And if you're only paying someone a few $1,000s, the risk is low, right? The higher the payments, the more careful you should be. Finally, Don't treat people like shit on the way out. Okay, always keep it professional, even if someone's burned you. Everyone has felt slighted in business, but if you send someone off angry, they're more likely to claim they should have been an employee. And remember, even if they're wrong, okay, they're financially motivated to do it because it can save them 7.65% in payroll taxes. Even if you win, you're still usually paying someone like me to fight it. So here's the bottom line. A lot of business owners have exposure when it comes to classifying people as 1099 contractors versus W-2 employees. As the business owner, you get to choose the risk that you take, but make that choice with clear eyes on what it could cost. Misclassified payroll caught by the IRS doesn't just disappear, even if you had good intentions. IRS payroll tax bills can haunt you for years to come with personal liability, but the good news is there's best practices that can dramatically reduce your exposure. And if you want more straight talk on tax law without the gimmicks, hit subscribe because you don't want to miss the next one.